Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a specific healthcare biotechnology company under the microscope, one that's been flashing some serious red on our hard-to-borrow screener. We're talking about VRAX Biolabs Group Limited, or VRAX. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. The company logo/stock chart VRAX Biolabs Group Limited, trading as VRAX, is a biotechnology company with a market capitalization of just $3.01 million. They specialize in immune response detection, T-cell immune profiling, and developing in vitro diagnostic technologies for viral and immune-mediated diseases across the United Kingdom, the United States, and China. In terms of recent price action, VRAX saw a modest increase of plus 2.64% today, and over the last 5 trading days, it's a plus 4.1%. However, looking at the past 30 days, the stock is down minus 26.95%. Volume has been relatively low to date, with 314,300 shares traded, which is significantly below its 30-day average volume of 3,075,239 shares, giving it a relative volume of only 0.1 average. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care? When we talk about a stock being hard to borrow, we're referring to the difficulty short sellers face in finding shares to short sell. To short a stock, you essentially borrow shares, sell them, and hope to buy them back later at a lower price to return them, pocketing the difference. But borrowing shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. When a stock CTB skyrockets, it's a strong signal that there's either extremely high demand from short sellers to borrow the limited available shares, or the supply of shares willing to be lent out is incredibly low, or both. These fees can easily exceed 100% annually, meaning short sellers are paying a premium just to maintain their positions. Why this stock is hard to borrow right now? Now, let's look at the specifics for VRAX. Our screener shows the annualized cost to borrow fee for VRAX Biolabs Group Limited is an astronomical 680.2%. Yes, you heard that right, 680.2% annualized. While the CTB momentum has seen a decrease of minus 71 percentage points over the last approximately 5 trading days, signaling a slight easing in the rate of the fee, the underlying rate is still extraordinarily high. Adding to the squeeze potential, there are only about 6,000 shares currently available to borrow. Compare that to the estimated float of 0.8 million shares for VRAX, and you can see how incredibly tight the supply is. Our composite squeeze score, which combines various factors like CTB, borrow supply, and technical setup, stands at 46.5 out of 100 for VRAX. This indicates a moderate potential setup, not extremely high, but definitely worth monitoring. It's important to remember, though, that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a hefty price to maintain their short positions. Squeeze mechanics explained. For those new to this, a short squeeze happens when the price of a heavily shorted stock rapidly rises, forcing short sellers to buy back shares to cover their positions and limit their losses. This forced buying creates even more demand, driving the price up further in a cascading effect. When shares available to borrow are as scarce as they are for VRAX, with only 6,000 shares available, any upward price movement can put immense pressure on short sellers, especially if their losses mount or they face margin calls from their brokers. They have to find shares to buy back, and with limited supply, they might be forced to pay higher and higher prices. Dilution risk check. One crucial factor we always check for is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of outstanding shares and can reduce the value of existing shares. It also provides new supply for short sellers to cover, potentially negating a squeeze thesis even with high cost to borrow fees. For VRAX Biolabs Group Limited, we found no recent dilutive SEC filings such as SMINS1, SMINS3, or 424B in the last 90 days. This is a positive sign, as it suggests the company isn't currently flooding the market with new shares, which could otherwise dampen any potential upward momentum. Recent reverse split watch. Another important piece of information for VRAX is its recent reverse stock split. VRAX Biolabs Group Limited executed a 1-for-25 reverse stock split on June 26, which was just 24 days ago. A reverse split reduces the total number of outstanding shares and proportionally increases the share price. So, if you own 25 shares, you now own 1, but its price should be 25 times higher. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the reset share count and higher nominal price can sometimes attract new interest or short-term trading momentum. However, this is a pattern observed in some microcaps, not a guarantee, and these stocks remain inherently risky. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're watching VRAX, what should you keep an eye on? To chart with key levels first, monitor the cost to borrow fee and the supply of borrowable shares. Any further significant reduction in available shares or an increase in the CTB fee, despite its recent negative momentum, would be a strong indicator. Second, watch for a sustained increase in volume, especially relative to its very low 0.1x average today. Highlight volume BAR. High volume often signals increased interest and conviction. Third, keep an eye on price action. Can VRAX build on its recent small gains and break above key resistance levels? Finally, given its biotech sector, any news or developments from VRAX Biolabs Group Limited regarding their T-cell immune profiling or diagnostic technologies could be a significant catalyst. In summary, VRAX Biolabs Group Limited, or VRAX, presents an interesting case study with its exceptionally high 680.2% cost to borrow fee and extremely limited 6,000 shares available to borrow, all within a month of a 1/4-25 reverse stock split. While our internal squeeze score is moderate at 46.5, and there's no immediate dilution risk, the combination of factors makes VRAX a stock worth watching purely for educational purposes. Remember, the market is complex, and high CTB is just one piece of the puzzle. If you found this deep dive into VRAX informative, please hit that like button, subscribe to the channel for more unique analyses, and let us know in the comments below what other hard-to-borrow stocks you'd like us to cover.